Hello and welcome to Stock and Roll, the podcast where we deep dive into the world of equity compensation. Today, I'm thrilled to have Carine Schneider joining us. I see Carine as one of the most experienced professionals in our domain worldwide, and her US view of things is something that I'm very curious to dive into. Carine will share insights on cross-border challenges companies face when they expand internationally, the emerging trends in private market liquidity, also with the US versus Europe view. Whether you're a European company looking to crack the US market, an American firm navigating in European regulations, or just trying to understand where equity compensation is heading next, this episode is packed with expert insights and practical takeaways. So let's dive into the market evolution, regulatory complexities, innovative solutions, and so much more. Super to be here with another episode of the Stock and Roll podcast. This time we're here with what we should call like an extremely experienced industry person. Happy to welcome you, Carine Schneider. I think I'll leave it over to you to kind of introduce yourself, since you have a bit more of background than what the normal kind of podcast participant we've had here had.
Well, thanks for having me. I'm excited to be here. A little bit about myself. I've been in the what I would call the share plan industry or stock plans pretty much since the start. I was actually at Oracle, went through the IPO at Oracle. And after the IPO, a lot of people were sitting on a lot of money, paper money that they wanted to get to. So I was given the job of figuring out how these people could exercise all these stock options and make a lot of money. And interestingly, a lot of them then went and retired or went and did something fun because they made so much money. So I was there kind of at the beginning before we had systems and the internet and voicemail and all of that. So I've been around a while. Did a couple of other things in my career. I was the founder and CEO of Global Shares. I was the CEO of a company called Certain or Easy, which is now owned by Insight Software. I was a partner at PwC kind of around the turn of the century in the .com time. That was very interesting in helping big companies develop and design large global plans. And then I ended up taking kind of a right turn around 2015 or so, and I went and became president of NASDAQ Private Market and was also president of Equinity Private Company Solutions, where we built a cap table software for private companies called Estrella. And now I'm a founding partner of a strategic advisory firm called Compass Strategic Advisors, based here in Silicon Valley. And I'm also the chair of the board of a publicly traded company, a NASDAQ traded company, and I'm on the compensation committee there. So lots of different things. And I just published yesterday the second edition of my book called The Democratization of the Private Market. So lots going on. I like to stay very busy.
Definitely super interesting to have you here. It's like it's an honor to be able to kind of pick your brains a bit on what's going on. And I think I'll continue then a bit. Like what we want to explore a bit today is bridging. Like obviously, most of our listeners historically has been in Europe, but we see more and more call it attention from US listeners, and also a lot of our listeners that are very curious about. Like we have US employees. How do we do it in the US? What's going on with the US? So I think like that's the umbrella, you can call it, of what we want to do here. So let's start off a bit broad and saying, if you look at the landscape of equity compensation in US, what would you say is, how has it evolved over, let's say, the last 10, 20 years? And how do you see it now versus when you started the early stages of your career looking at the US?
Yeah. Well, when I started, everybody did stock options. Private companies, public companies, big companies, little companies, it didn't matter. Everyone did stock options. And I think in the early days, outside of Silicon Valley, it wasn't broad-based. It was seen as an executive perk, and rank and file employees wouldn't receive an award. I think there was a feeling of, well, they wouldn't understand it. It's too complex. The tax issues could be an issue. And in the United States, we have two different types of stock options, one that's more tax advantaged and one that's not. And then around the .com time, everyone was giving a stock option to everyone. And it really bled into these larger companies saying, well, maybe all employees should get them. And so you started to see these 90,000 employees, 150,000 employees getting a stock option. And And then expensing came in, and all of a sudden these things weren't free anymore. And so everybody started, when something's not free anymore, you start to value them and you start to look at the cost. And then people started to say, well, maybe we don't want to give them to everybody. Maybe they didn't really understand what they got. And so it's kind of a waste of money. And employee stock purchase plans became much more popular for broad based. And then around 2008, when we had the financial crisis, all of a sudden these stock options were worthless because the stock prices had fallen so far, and everybody moved to RSUs. And you started to see companies like Facebook and Cisco and Google and places like that start to say, maybe we shouldn't do stock options because they have the possibility of being worthless. And at least with an RSU, you get something at the end of the day. And so then the pendulum swung and everybody went to RSUs and private companies started doing RSUs. And the tax situation in the US is that at the time of vesting, you pay tax on the value of the RSU. So you start to have a lot of employees in private companies who said, I don't have that money and I can't sell the stock. So it's not working for me. But you saw this situation where people on boards said, well, my other company, we do our shoes, but their other company might have been public and they didn't understand the nuance. We really haven't changed from that. Expensing hasn't changed much in the US really in the last 15, 20 years. RSUs are still what most people kind of gravitate to. I would say that most companies don't do broad-based anymore unless you're, startup or you're in high tech. And even the big tech companies have started to look at the cost of the option or the RSU and said, I'm not sure we need to give this to everybody. So that's kind of what you've seen. But I would say the last 10 years have been pretty boring. There was, I will say, an attempt in there to do some performance-based grants, which I know are much more popular in Europe. And we still do them for executives here in the US, mostly in publicly held companies, but they're complex to manage. If you talk to most of the recipients, they'll tell you they don't have a clue what they need to do in order to earn them. And so you kind of miss that connection between, hey, we're trying to get you to do something. And you're saying, I don't even know what I'm supposed to do. So is there really a value in those awards? But that's what shareholder rights groups wanted. So I would say at a high level what we're seeing.
Mhm. Oh, super, super interesting. I think it's like just reflecting on it. It's like when you see that, um, call it US GAAP or IFRS equivalent here, is starting to introduce now. It certainly is a salary expense that should be amortized and kind of visible and reflecting in your accounts. I think that actually is so strong that it changes what sort of instrument types you're doing. I think that's quite interesting. Obviously, as well, share prices deeply kind of going down, and then people are trending towards RSUs. That's stuff that we've seen a bit of here as well. It's like when it's retention that is the most important thing. Options may not necessarily be the right tool, but it's though it's super interesting to hear. And of course, like with the history scope that you have, you kind of get the long lines in it as well. Just a question on like in Europe, different countries, right? But it's like in some of the countries we see more and more of like saving plans where kind of all employees are being invited into joining in some sense. Do you see those kind of instruments? Do you have any kind of tax qualified or kind of tax benefit plans that involves a broader range of people in terms of similar to the SAYEs in
Yeah.
UK and so?
Yeah. So we have Section 423 under the IRS code, which allows you to provide for a qualified employee stock purchase plan. Unlike SAYE or SIP or any of the other plans in Europe, it's not really a savings plan in that the difference is you have payroll deduction for a period of time and the company determines, on average, it's either 3 months or 6 months. So again, much shorter than the UK. And during that time, you're saving the money from your paycheck. And generally, you can go up to, on average, 10% of your paycheck. And that money does not earn any interest. So, again, it's not a savings plan. The company sits on the money. And at the end of the period of time, let's say it's 6 months, you are, as a company, allowed to offer a 15% discount of the lower price of either the price on the first day of the 6 months or the last day of the 6 months. So if your stock price is going up, it's terrific because at the end you can get a 15% discount on that early price. And then shares are purchased and then shares are deposited into an account. And again, a little unlike the UK where you can choose not to purchase the shares. In the US, there's no choice. You purchase the shares, and the shares are then generally freely tradable. There are some companies that don't allow you to sell right away. And then if you hold the stock for a year, you get capital gains instead of short-term income. So that's the only thing we have, and I would love to have an SAYE type idea here in the US. I think a lot of people would participate. But to give you an idea, they're very popular plans. They're generally available to everyone. You can discriminate in the plan by not including union employees or not including executives. But for the rest, you can't discriminate. All full-time employees need to be offered the plan in the United States. And it is very popular. I would say in a high tech company, you're probably seeing participation rates in the 80 to 90%, really high. In, I would say, more consumer-oriented or manufacturing companies, you're probably seeing 35 to 50% participation rates. So they're pretty popular.
Yeah, definitely. Then a question that we always kind of, when we talk across kind of different countries here, is like for European bigger companies that have a bigger amount of US employees. Obviously, like European companies pivot and kind of making it kind of into the US is on all growth companies kind of a long-term roadmap, you could say, at least in the pitch decks. But it's like, do you see that European companies adapt and do, let's say, ISOs or any other elements for their US part of participants, or do they stay with the European? That would be typically a non-qualified option, or any other kind of adaptations. Do you have any reflections on that?
Well, they generally offer an ESPP, the 423 plan. So I see that common. When it comes to the awards, I would say most do not do the ISO. It's complicated to manage. Most public companies don't do it. You're limited in how much you can grant. It's up to $100,000 per year of value. So most of them just go straight to a non-qualified stock option, or they do the RSU. Again, RSUs are just much more popular. It kind of depends on the type of company and the type of employee. So smaller companies, stock options; larger companies, more likely RSUs.
Yeah, oh, cool. And the opposite way around. So if there's a US company with people in Europe, obviously Europe isn't Europe, but just like a bit of like the reflections around that.
Yeah, when I was at PwC, and I was at Watson Wyatt as a consultant as well. I spent a lot of time working with European companies coming in the US, and they were very sensitive to our tax code and what we were doing. When you talk to American companies about going to Europe, I always joke, Americans don't even know how to dial a phone number to get to Europe. I mean, it's the time zone is difficult, let alone trying to adjust their share plans to what is happening in Europe. So I would say larger, more sophisticated companies, publicly traded companies, are going to be sensitive to the fact that there are different tax regimes, securities laws, employment laws. I mean, we do not understand what a works council is in the US. If you stop 10 people on the street and said, can you tell me what a works council is? 10 of them would tell you, no, I don't know what that is. So we really don't understand some of the employment laws. And I know in the Nordics, you guys certainly have laws that are very different than what we're used to in the US. And so companies that can spend the money and time on legal and tax advice, they'll be very sensitive and they'll adjust, and the plans will be specific to the different countries. But I would say a company that that isn't very large, that isn't very sophisticated, doesn't have a lot of employees in certain countries, they're going to do an American style plan, and they're going to let the European employee figure out what they need to do. And I've seen it really hurt companies many times, especially if there's a reduction in force. Then you start to find out that there's a lot of laws that they didn't understand when they were making these awards, and that even the agreements were not written properly. And so it generally favors the employee, the European employee.
Yeah, I think one of the challenges that we have here is like kind of European companies employing people in US and the other way around as well. How do you kind of maintain competitive in the recruitment market if it's a European company that comes into US and you can, of course, it's easy to say that we won't adapt. We want to kind of do what we have here and offer it. But if that kind of excludes talent, then you have a challenge. But the other way around, if you try to tailor to all jurisdictions, you would end up with a mess that is like a several head monster. You can't really administrate it, and you kind of make it difficult for you. So finding that balance there, I think it's have to be a bit case by case, but it's always tough. Yeah.
Yeah.
The IPO market, like macro trends, kind of have slowed that down globally, I would say, or that's not fully right. There are some jurisdictions where it's still been quite a lot of IPOs, but like in US and Europe. So from the US point of view, how do you see the market? Are there any kind of recent trends? Do you see companies IPO, or is it optimism there now, or just your feel and temp on that?
Yeah, it changes every day. There was a lot of optimism for 2025, and going into it, I had lunch at the New York Stock Exchange, I think in September, and they were all, "Oh, next year's going to be so busy, and we won't have time to have lunch." And the opposite has happened. The new SEC chairman, Chairman Atkins, has now been sworn in, so he has taken over. Although the interim chairperson was very aligned with him. And he's a very, obviously from President Trump, there's a focus on deregulation. And that's always been the issue, I would say, over the last 5 to 10 years. As a chairman of a board of a public company, I can tell you the cost and the time we spend being a public company. There's certainly a discussion, it doesn't make sense. So with the new chairman in place, he has been clear. He had a presentation yesterday, May 19th. He gave his first remarks as the chairman. So we've got for the first time to kind of hear what his thoughts are. And he's very pro crypto and focused on the crypto market. It looks like SPACs may be making a little comeback. And I think there is a feeling of let's make the private market easier for investors to participate in. And all of that makes you wonder, what is that really gonna do to a traditional IPO? We're also seeing other markets are much more robust. India is very robust right now. China's got its own issues, but the Nordics, First North, the Nasdaq market there in Sweden is very, very active. So I think that there's a lot of alternatives now for companies that weren't there before. You either got on Nasdaq or New York Stock Exchange, maybe London Stock Exchange, or you didn't. Now there's so many other kind of hybrids that you can do. So I'm not optimistic that we're going to see, well, we're certainly not going to see much of a change in 2025. Even the companies that are going public right now are doing okay. They're not, hitting it out of the ballpark. So I think now, hear everyone say, "Oh, 2026," but even then, I'm a little more cautious. I wouldn't spend the money right now.
Mm. So you think that like there's a risk that now it's quite dry, nothing happening, and what's happening then as a consequence is that the alternatives get better and more robust, so you can stay
Right.
private for a longer time, and that's okay because why do you need to go public? It's a lot of work. Yeah, yeah.
Yeah.
No, I think that's a very, very, yeah, some good reflections. I think from the European point of view, you still see like the bigger and most ambitious companies from here, they want to IPO in US. Do you think that will continue, or is it a
Yeah.
fear that yeah.
Yeah, I mean, the capital markets, the public capital markets, they're not completely dead, but it's not like the old days where, you had an IPO every week, you knew the brand, you knew the name, you got excited, the stock went up, everybody's making money. You're not seeing that. And even now, when you see an IPO of a company that's relatively well known, um, there is kind of okay, a little blip on the IPO day, and then by the 180-day lockup, which we in the US have, most people can't sell for 180 days. By the time those 180 days are over, the stock price is not generally not done very well. So a lot of people are like, why wouldn't I just sell before IPO? Why would I allow myself to be locked in for 180 days? And that just makes the secondary market or the private market so much more robust.
Yeah. And on that note, when it comes to share plans, stock options, RSUs, all these things, do you feel that the lack of IPOs has kind of changed a bit how people perceive their equity as well in call it like the private market, because they may see longer way to liquidity. Do we need to consider that in design? Do people kind of get more hesitant and less eager on equity because of this, or?
I don't really see it, and I've got a number of nieces who are working at these companies, and my son and other people. I think what they're seeing is there is a robust private market now for the right companies, and I want to be really clear. Just because you work for a private company doesn't mean you're part of the private market. But there are now organized programs and technology to support you. So if you are working for a company that's doing quite well, there are ways for you to see this liquidity. It's not always at your time frame, so you're losing out on that on a public company. Obviously, any day the market's open, you can generally sell. Although I will tell you, in a lot of public companies now, in the US, we have blackout periods, and those blackout periods used to be when I was starting out, it was the top 10 people, top 20 people in the company who were considered insiders and had a blackout. Now, my son-in-law works for a company where every single employee is considered an insider and has a blackout period. So there's only 8 weeks of the year that he can sell his stock in a public company. And it has an impact on people because you start to think, well, wait a minute, now I'm watching the stock price go up. I can't do anything. If I worked for a private company, the price isn't so volatile. So if the price is then if I know what the price is and there's a liquidity program offered by my company, I may actually do better and I actually may make more money because when I received the award, the stock price was so much lower than if I work for a public company where maybe I'll make $1, $2, $5 gain. In a private company, I may make $50 in gain because, the appreciation has been so robust because we're a private company that's seen as having more value.
Definitely. I think what you touched upon there is still quite a significant difference between US and Europe, because I think like the liquidity in private markets in Europe, it's a bit like of course you can still see a way of earning on your options or your RSUs or your shares, but you're a bit dependent on transactions, fundraising, some secondary kind of stuff being kind of put in place. Well, I see in the US, there's a lot more development being done in really offering this as a service and creating liquidity without being on a unregulated stock market.
I would say, though, on that with Pisces in the UK, I think that's going to have an impact on Europe. I mean, hopefully it goes well. But I think Pisces is this private market that the UK government is supporting and putting some structure behind. And they're doing this to encourage private companies to stay private and have the liquidity and feel comfortable in that environment and not the rushing to exit. And so it has a structure somewhat like the US, although in the US we don't have the government behind it. We have very few regulations. In the UK, there's going to be very clear structure. And I'm curious, if you know better than I would, does something like that start to infect Europe? And do you start to see more European countries saying, working in the UK, maybe we need to do something like that as well?
I think that for now, it's a bit. There's been a lot of initiatives from here, or kind of many companies, many kind of initiatives in trying to create this sort of liquidity in the public, no, in the private side. But it's, I think it's still a bit not really there. You mentioned these kind of First North Merkur markets in the Nordics. There are some entry stock exchanges launched where it's less of like a compliance demand and easier to kind of get liquidity on it, and that I think is a good thing. But I don't think it's still, if you are a growth company, you're doing well, you would still consider an IPO or an exit to private equity like the big ways of getting liquidity on your stocks or your RSUs or your options. And I think in Europe it's a bit change in a communication thing, because where people were basically saying we will do this until an IPO, now it's more like the shift is a bit on related to fundraising modes, or there will be secondary transactions, and just but bottom line is we build a good company together, we conquer the market, and you need to kind of believe that there will be some sort of output. So I think that is a bit of a change how you need to communicate more on like creating value for the company together, building a good business, and there will be exit opportunities, but it's not that clear when the IPO market is as slow as now.
Yeah. I would say too, private equity wasn't really as robust as it is 10, 15 years ago. Now, if you're working for a company, whether they're public or private, there's a very good chance that the exit will actually be a sale, not a listing. And so I think there are a lot of people too who say, well, I hope we get bought in the next year and, then I get 100% payout on whatever I have and I move on to the next gig.
Yeah. Yeah. And there you also have quite predictable cycles, right? Because these private equities, they have like 4 to 7, 8 years. You would know that there's something happening, right? So that will also create some sort of like expectations. Yes, it's not as liquid as being able to trade on a daily basis, but it's still something you can communicate.
Yeah.
When it comes to I'm just a bit curious about like your experience in Nasdaq private markets. Could you just explain a bit, like what have you done with or what do Nasdaq private markets do? And does that have an impact the way you see it on equity programs?
Yeah. I mean, when we started Nasdaq Private Market or NPM, it was designed, there was no private market. And I think Nasdaq really saw the writing on the wall that these companies were going to stay private longer and that you wanted a good relationship with those companies while they were private so that when they did go public, they would obviously select Nasdaq over New York Stock Exchange. That was really the initial thought. Interestingly, most of our initial clients were European. Spotify, Shazam, Farfetch. I mean, these are, I always thought it was funny. I was spending more time in Europe than I was in the US. And then over time, Nasdaq is actually now spun off from Nasdaq Private Market is no longer, Nasdaq is an owner in Nasdaq Private Market, but it's owned by most of the banks, most large multinational banks. And the focus now is really on a couple of things. One, offering the technology to allow companies to provide a liquidity program to their employees. So this is a situation where a company is either fundraising and they have extra money, or the company themselves could buy back the stock from the employee, and it gives the employee an opportunity to sell. And generally, it means exercise and sell your stock option. And there are rules around how much you can sell and who can sell and all those types of things. And the company determines that. But what they've really moved into is doing these three-party transactions. So the three parties are a buyer, a seller, and the company. And so it could be a large institutional buyer. It could be Fidelity, or I know the Saudi royal family is very, very active. It could be Tiger Global, whoever it is. Someone large comes in and says, look, I want to buy $10 million worth of Stripe stock. I want to acquire that. Now, you could go directly to the company, and the company may say, well, we don't want to issue new shares. And we're not fundraising and we don't need your money. So we're fine. So what they'll do is they'll go onto the Nasdaq private market, and there are competitors. There's a large company called Forge Global, which is another one that does this, and many more. And you could go to them and say, I'd like to buy $10 million worth of Stripe. Can you go find me some shareholders out there who are interested in selling? And you may find that it takes 4 or 5 shareholders to make the $10 million. So you have to do some work there. And once you identify who the sellers are and the buyer, and they determine a price, because the price is generally set between the two parties, you then need to go to the company and ask the company if they will approve the transaction, because they generally have what's called a ROFR, or a right of first refusal. So the company could decide to say no, or the company can allow the transaction. And the company, of course, is very concerned about their cap table. So who is actually buying the stock? Could it be a competitor? Could it be someone that we don't want to be a shareholder? Which, again, in the private side, you have that luxury. In the public company side, you do not. And so if the company approves it, then the transaction goes through. Now, in reality, that whole thing that I just described could take 2 or 3 months. And on the very last day, before everybody has to sign all the papers, the buyer could say, I don't want to do it anymore. Or the seller could say, not interested to sell. Over those 2 months, things have gone so well. Why would I sell my stock? So it's a very unstable market in that it takes a lot of paperwork. It's expensive. It's time consuming. And it's a little bit of who you know. And of course, I should make one caveat. In the United States, you have to be an accredited investor to participate in this. So it's an interesting marketplace, and what I will tell you is, it is maturing very quickly. There are more and more players entering this market, doing different things, and it's starting to get to a point where very large financial institutions worldwide are participating in this because they're seeing the appreciation in the stock happening on the private side, not on the public side. So many of these companies may not even own the stock at the time of IPO, if there is an IPO.
Mm. I think what you kind of touched upon there is one of the, because again, back to, it's been some initiatives in Europe as well, trying to kind of create similar to yeah, let's use Forge as an example, right? I think one of the challenges that we've had here is exactly that. You want to kind of make something more liquid, easier, faster, but you kind of, as a company, and you mentioned it, like you would like to keep full control of who's on your cap table as a private company, and how do you manage to kind of set up something, some rules, so how much do you give away of the control of who's coming in versus creating the liquidity in your share, and somewhere along that kind of line there, there's this breaking point. So how would you say it is today with the solutions in US? Because I know that this is one of the reasons why people haven't jumped on the solutions in Europe. Do you feel that it's possible to set the rules? Have they given up more of the control for the sake of liquidity, or are we still more on the control side and liquidity is not that open? And this is just me being curious.
Newer private companies, I see the founders of these newer companies being a little more flexible. Um, they're still gonna look and see who the buyers are. So that's not ever they're never I don't think we'll ever get to a point where they're like, just whomever. They wanna know that. But what I think is, I would say 5 years ago, it was very much, "Well, I like Bob, but I don't like Sue. So I'm gonna let Bob do this, I'm not gonna let Sue do this." I think now it's more, "Look, if you have a reason you need to sell the shares, go ahead." I remember we did the Uber, liquidity program. We would do it on a quarterly basis, and Travis believed that you had to be fully vested in your stock option before you could participate at all. And he
Mhm.
saw that as a loyalty test. So if you were fully vested, it meant you had stayed 4 years. If you stayed 4 years, then you would have the ability to sell 10 or 20% of your stock in one of these programs. What you get are these personalities from the founders getting into it. I would also say 10, 15 years ago, the venture capitalists had a lot to say. And, if I had a dollar for every venture capitalist who said, well, I have to stay until the end, so everybody else has to stay until the end. You don't hear that anymore. That now there's an understanding. These people have worked hard. They have been here for a number of years. They're living in an apartment and eating top ramen. I think it's fair that they should get some money from the time that they've spent building this company. So I do think that these programs are much, much more accepted. NASDAQ Private Market puts out a great report every 6 months about what they're seeing in the market. And both NASDAQ, Net Private Market, and Forge, who also has a great report, you could just see that the activity is really picking up. So I don't think they're stopping it so much anymore. Again, an individual situation, they will say no. But, I also think this is a method where people are starting to clean up the cap table. So where the first 3 or 4 years of the company, they gave it away to everybody got a stock option. Now we're kind of in year 5, year 6, we're starting to think about where we're going, and someone looks at the cap table and says, "There's too many people on here with too tiny amount of shares. Let's get rid of those people." Especially ex-employees, that's very popular here. "Let's get those ex-employees off the cap table. We don't want them owning any of our shares. Let's just pay them, and they can be on their merry way."
Yeah, I think it's also like, when you go from being a historically being a private company to a public company, it's such a big change. So you know that this is like, we lose control. There will be anyone buying shares, and you're so prepared, and you kind of run up to an IPO, and it's this huge process, and then you IPO, and then you're in a different world. I think it's like, it takes some time for private companies, founders to kind of go from call it like where I am now, where we really want like, what's your value add? How can we work together? That's where you kind of build the company from the start, right? And then this is a step in between. So you need to let go of that setup. And I guess it's more of a maturity thing as well to kind of get there. And I think that will take time, and probably is one of the things that have been challenging with similar initiatives in Europe so far, that it's like you want to maintain the same control and then you end up ruining the potential liquidity. Then it's not so attractive to be an investor on those things, and you don't really get the flywheel running. So you need to kind of start on one of the sides, and I guess it's as you say, it's a bit of a maturity thing on that has happened in US, but not necessarily yet in Europe.
Yeah, and it's an experience thing as well, because you're starting to see more and more entrepreneurs who were PayPal, Facebook, Google. Those guys have all left and started new companies. And when they started their new companies, they looked at things very differently. So I do think you're going to see that in Europe, where you're going to start to see these entrepreneurs,
Hmm.
founders who have done very well starting a new company and saying, oh, I'm doing it totally differently this time.
Yeah, very good point. Back to a bit like the equity compensation sides of it, like things that are in US tend to come to Europe a year or five later. But if you were to think now, based on the trends that you see, you talked a bit about like the history. Are there any things you see now that you think is new, fresh stuff that are very, very up and coming, that you think we in Europe need to kind of be aware, and there's a likelihood that it will be more of it later also in Europe?
One thing I've seen in the last few years is lending. So when I explained that 423 ESPP plan, if you don't have the money to put aside for 6 months, you can't participate in that plan. Well, there are now people who will lend you that money, and they'll say, "Look, we'll give you the 10%. That way, you get to participate, and then at the end of 6 months, we'll just split the appreciation that we made." And so you get a little something. I'm seeing that for stock option exercising and tax as well. We're seeing that in the private market as well, lending against these stock options for tax purposes, so you can exercise them and hold or exercise them and sell. So I would say that's a trend. I don't know if you've seen that much in Europe, but people ask me how I feel about it for the ESPP side, and I really struggle, because part of me, having run these plans, this is for the employee to participate, and there's a little pain that you have to feel. And the company assumes that not everyone is going to participate. And so many shares are set aside for the plan based on, let's say, a 70% participation. But now, if everybody can borrow the money, then you get 100% participation. Then you're going through a lot more shares than you had initially thought, which means you could run out of shares quicker, which means the plan might end sooner, because shareholders might say, well, this isn't really doing what we expected. Now you're borrowing this money and you're splitting the proceeds with some company that, is taking advantage of this. So I think this is going to be, if you're not seeing it in Europe yet, it's probably coming your way. And again, these are private lenders. These are not banks. You're not going to the bank and filling out an application. But be prepared for that. That's something somewhat new.
Yeah, it's super exciting. I think it's definitely something that like private lenders loaning to equity program is not very common the way I see it here yet. I think it's super interesting because obviously like there's cons and there's pros with it. The good thing is if it's structured the right way, you can kind of enable more people to join. It's easier accessible and you kind of structure it. But what I'm a bit curious about, like what sort of security do the lender have in it? Do they actually value the shares at anything? Because you can't do that with a bank, right? At least if it's a private company. So just like how do they consider risk of default, and what are their security in this?
So on the ESPP side, on the public side, it's obviously the shares are there. That's easy. And you sign something that says, I promise to share the proceeds with you. On the private side, these are mostly funds. So funds that have been raised specifically to lend against this. The funds will have a lot of rules. So one of them will be, it's got to be a pretty mature private company. So it's going to be a
Mm.
company that's already trading on NASDAQ Private Market Forge, things like that. These funds will also only lend a certain percentage of the fund, so they don't have this over concentration in one particular company. And generally, it's a 5-year loan, and it's generally there's an expectation within those 5 years that there will be an exit or a liquidity program. So it could be that there's no exit, but there's a liquidity program, and then the lender can say to the borrower, "You have to sell in this liquidity program to pay us back because, it's
Mm.
been 4.5 years now and the clock is ticking." And you're paying an interest rate. You're generally paying a higher interest rate than you could get from a bank. Not quite a credit card interest rate, but, not a bank interest rate, so you're paying a little bit more. And some of these loans are designed where when the exit occurs, you as the borrower can choose either to pay back, the interest and also the money you borrowed, or you can just give shares. So you could say, I'm just gonna give you 100 shares, and that'll cover all the interest and all the money I borrowed, and now you have 100 shares of this public company. Or I can say, "Here's $100,000. It covers everything I borrowed. You're not getting my 100 shares because I believe the shares are gonna appreciate, so I don't wanna give you the shares." Some funds require you to give shares because what they wanna do now is continue to appreciate, with the price. So they're somewhat complicated, but what's weird is, or not weird, but there is no, it could default very easily. So it's not like they're sitting on some type of asset that they can turn around and sell. If everything blows up, the fund and the lender is out of money. But then if you look at a venture capital fund, same thing could happen there. I think right now people think 20% of venture capital funds actually provide a return. So, it's a
Yeah,
similar gamble.
it is. I think it's very interesting. What we've seen in some of the jurisdictions that we've been closely on is that like it can be some loans that can be provided by the company as long as you give it to all employees. It's obviously in smaller amounts, but it will kind of allow people to buy upfront and pay back over the next 12 months, an example. Obviously, smaller amounts, low interest rates, just to kind of get the participation up and make it easier for to join. I think that is generally a good thing, but that's not that side of a gearing that you see in the programs that you discuss. And obviously, the private equity investors come in and they give you some sort of gearings, but that's typically to the
Yeah.
top people. When it comes to these lending partners leaning forward and doing like hedging in the underlying shares in the private, it's very rare that we've seen it here, but we got some questions about it, if it's possible or if we know someone or something. And so definitely understand that there's a need, and it's exciting to pay attention to the involvement in US and how this may impact Europe as well. Getting closer to the end here, but it's always a bit interesting to talk to people that have been around for a while in the industry and kind of what are in your mind like the biggest mistakes in either design or running a program, or for the listeners, like what to avoid if you're quite new into this. You are a 500 people private company. You want to design your program. You have some employees in US and some in Europe. Are there any big pitfalls or stuff that you've seen around that you should be extra careful for?
Yeah. I think it goes back again to the kind of advice that you get. There's a lot of information and advice available now. Um, one thing I see so often, I said it earlier, is either executives or board members saying, "Well, at my other company, we do this," and it's really not relevant. And I can see when I see a design of a plan, I can tell which law firm has designed it because they just do the same thing over and over again. And maybe to make a plug for my former profession of being a comp consultant, you do actually have to look at why you're doing this. And I think companies sometimes forget, as you said, is it retention? Is it motivation? Is it attraction? Could be all three. I'm not saying it can only be one, but why are you actually doing this? And I have found, and when I was doing the big global plans, sometimes stock isn't the right answer. And I think that if you're not going to put some time and money in education and helping people understand, yeah, it really is a waste of money. And it's a waste it hurts the shareholder because you're diluting the shareholder by giving something to somebody who doesn't get it. And so, I mean, I always laugh. I have a niece who calls me every time she gets a new job. She calls me and says, "Okay, I got this stock thing. What can you read it and tell me what it is?" And a couple jobs ago, she sent it to me, and it was so bad. It was so. I mean, I actually spread it around to all my stock plan buddies because I was like, "You got to see what this company has done." And I said to my niece, this is not good. You are being asked to put money into something that is not going to pay off in the end. And I think that you do need to be very thoughtful about what you're doing. I think if you're going to start granting in other countries, any other country, if you're an American and you're going to grant in Canada, you need to understand the way things work there, the rules, and not just tax rules. It's more than that. So I think those are kind of the mistakes I see people make, that they don't really think it through. They do whatever they did somewhere else. They don't do the research, and they skimp on the education. And it's so easy to spend 30 minutes with your employees and have a little PowerPoint. And I think companies like yourselves or other companies out there would be more than happy to help their clients explain this to the employees and say to the employee, this is actually what you have. And if you're not willing to do that, then make it an executive plan, because I think, for the broad-based employee, this is very difficult. I remember when Uber granted RSUs in Australia, and all these drivers got RSUs. Well, in Australia at the time, you had to pay tax on grant. So all these drivers of Uber in Australia are saying, I don't want this. And they're like, well, there's nothing you could do. We granted it. It's in our board minutes. And they said, so the only thing I can do is quit. Like, that's the only thing I could do is to avoid paying tax that I don't have. I don't have this money. And that's an example where someone just didn't look carefully and say, Maybe we should do a stock option, not an RSU." So, you got to be careful on some of these things that happen, and there are enough professionals out there that a little bit of money on top of whatever you're spending in terms of an expense for these plans, a company has to be willing to invest, or just don't do it. Give them free lunches, or do something else. That was always my advice. I also think cash plans are interesting. We haven't talked about them, but I do think cash plans are great for especially lower level employees. They value it tremendously. And in many countries, they value it more than they would equity.
Mm. Oh, I think while you go through these things, it's kind of I get like tons of examples, kind of the back of my head here. But it's like, to add on one of them, I remember there was a company that did a bit of like a research on like how much do you value this, and the exact same, call it like theoretical value, was valued at 100 somewhere and 10 somewhere, right? And when you get to that level, it's like it's a 10x how much you value it. Like, so you should basically just almost say, okay, I take it from you that value it one and compensate with some salary, and you give it to the other ones. It's like, this is like, and of course this can be education, it can be risk profiles, it can be where you come from, it can be a lot of things, but like understanding those mechanisms when you design a program, and not making a program here where everyone's on the 10th side of it and you kind of get absolutely no bang for the bucks. I think that's
Yeah.
super, super important.
I think too, you have to think about what it costs to sell something as well. So I've done plans where we did the big Bank of America plan, and everyone got 150 stock options. And by the time we figured out what the commission would be to sell the 150 shares that you would get every time, you barely had enough money for lunch.
Mm.
That that's not going to get you retention, attraction, motivation. It's not going to do any of that. What you're going to get is irritation. And that ultimately was, what the employees would say. And they were writing the CEO saying, please stop doing this. I'd rather have better coffee in the break room. Why don't you spend your money
Yep,
there?
definitely. No, definitely. I'm gonna leave it with one more example because I thought I'd just
Yeah.
give it to add it, but it was another one where I saw that it was a company that had in their program that, in your position that you're now, you're not allowed to sell any of the shares that come from this stock option program, and then a person ended up having values at like 2-3 million euros or dollars. And the kind of the question that came back, so the only way I can kind of get this money is to quit. And it was, and that person, I'm not sure that was the reason why the person quit, but he ended up quitting, and then he or she was able to sell those shares and realize that money, and then you can, it's just
Yeah.
very poor design, and you need to think those things through. Yeah.
Yes. Yeah. I've heard that too.
Yeah. No, but awesome talking to you,
Yeah.
Carine. Would love to dig into both cash plans and more bloopers at a later stage. I think it's there's definitely tons of things to talk about. So, yeah, last thing, just saying thanks a lot. It was really great
My
talking to you.
Absolutely. Appreciate the time and putting all of this together. And I'm available if you want to talk more. So just let me know. And hopefully we'll be your way very soon.
Perfect. And good luck with the launch of your book. Yeah.
Thank you. Okay.
Okay.
Bye-bye.